All right, SpaceX IPO is taking off. And if you own an index fund, you're going to own SpaceX whether you want to or not. So SpaceX filed its S1 with the SEC on May 20th. And the IPO roadshow, which is what the investment bankers do when they go around talking to various banks and investors to try to buy the company, or at least the IPO portion of the company, opens on June 8th. SpaceX will be priced on June 11th, and trading will begin on June 12th on the NASDAQ under ticker SPCX. So they are planning to raise $75 billion, which is the largest IPO ever. It's more than double Saudi Aramco's 2019 record, which is Saudi Arabia's national oil company. They raised about 30 billion, and then it's more than 3 times Alibaba's US record of 22 billion back in 2014. So that $75 billion raise, they're currently targeting a $1.75 to $2 trillion valuation. So that's a huge number. Absolutely would make SpaceX immediately rank among the top 10 most valuable US companies, right ahead of Berkshire Hathaway. So it would only be comparable to Apple, Microsoft, Nvidia, some of the largest tech companies. So a massive, massive company. The IPO itself is going to be raising more money than all US IPOs combined in 2025, which was $47.4 billion approximately. Gordon and I are here to discuss whether or not this IPO makes sense and what it might mean for you as either a potential SpaceX investor or just a stock market investor with your passive index funds. So, Gordon, what do you think about this valuation at 1.75 trillion? That's saying that they're looking at a 94 times price to sales multiple. That's a little bit expensive for most people.
That's pretty expensive for me. Elon Musk will retain 85% ownership is one thing to note. And yeah, I just, when they come up with that multiple or that valuation, a lot of that is in the value of the XAI, which they have recently kind of pulled those two privately held entities together. Personally, I'd be more interested in owning Starlink if I was going to pick one. Starlink has a clear first mover advantage, owns so many of these satellites. XAI is kind of an also-ran in the quality of their builds. They're just not as accurate. They have more hallucinations. They're a couple of iterations behind OpenAI, Anthropic, and Google's Gemini. So, we don't see that kind of valuation with the competitors that are down the list behind those big three. And so if I was just given a choice, yes or no, I'm not participating in the IPO. I think it's too high.
Yeah, I'm not. I don't plan on participating either, nor are we going to be recommending it to any of our clients. It's definitely an intriguing company, specifically the Starlink part of it, and setting up rockets to space is interesting. But it really lost me when, like you had mentioned, the XAI, which it was Twitter that was merged with XAI, X, the social media company, and so SpaceX before the merger, pre-IPO, to try to boost its value before going public. Like SpaceX looked much more attractive from an investor standpoint, maybe not for those that held the company, because now they're able to try to sell it for almost $2 trillion to the open market. If the XAI merger had not happened, I think I would have been more interested in SpaceX, depending on the actual valuation. But like when you just do some comparisons, when you look at Saudi Aramco, which is not a good comparison, let's say, because it's a totally different company that is an oil producing company that is very much about profits and cash flow, not necessarily about potential with technology or AI or space. But I'm just comparing because of how large an IPO it was. It is the most profitable company on earth, and it is a 6 times price to sales multiple right now. Its revenue for the trailing 12 months, I believe, is $280 billion. And that's compared to SpaceX's trailing 12 months revenue of almost $19 billion. So you're looking at 20 to 280, was that 14 or something like that times more revenue for Saudi Aramco, and the valuation is approximately the same currently. When you look at Nvidia or Apple, Nvidia has a lot of growth also in the AI space at 3.3 trillion. Its revenue is 130 billion, and it's 25 times price to sales multiple in comparison to SpaceX's 93, 94 times price to sales multiple. So you're paying more than 3 times price for Nvidia. Apple is at 8 times price to sales, so you're paying more than 10 times, more than 11 times the price to sales of Apple. So is SpaceX's revenue really worth 10, 11 times or more than Apple's? Apple is not a dying company. There's still growth to it. You'd have to see SpaceX as having insane potential. When I look at some basic calculations, it depends on their final valuation and how the various parts of the company are broken up. But it looks like the SpaceX bull case, if you're buying this, is you're projecting 2034 perfection. So that would mean you're getting near potential profitability around 2034, and you would need 55% year over year compounded growth from now until 2034 for that multiple to make sense. And you're talking about perfection, it has to meet those at least to be able to justify it. So it's a little expensive. We'll just say that.
Also, when you think about like compared to NVIDIA, okay, this is an AI company. How is the AI going to grow faster than the chip maker? The suppliers, Google makes chips, and there are other chip makers besides NVIDIA, but NVIDIA is the most valuable of all of them. How can the supply of compute, if that's growing even at 20 times or 20% a year, how are the other companies that are dependent on that industry going to grow faster than that? I don't understand.
I guess maybe the justification, which I don't agree with, is just by putting those chips into space, it would just be so much more valuable that it's leveraging it somehow or making it a multiple of its value just by, instead of having to pay for electricity here and cooling here on the ground, be able to put it into space and have the void of space to be able to suck that heat out and be able to generate some of its own electricity with solar panels and such. But there's also other problems that I've heard about, the gamma rays or other kinds of solar radiation destroying the chips over time and just making it a problem if you put billions of dollars into space and then the sun just rips it apart. I don't know.
Well, and even though space is cold, without some kind of matter to transfer that kinetic energy, it's not so simple as just, it's cold there, so therefore it'll cool everything down. There's a lot of physics involved that's unsolved at this point.
Interesting. I'm no physicist, so I'll leave that to other people. I don't know how that all works. So let's talk about what some of the other IPO craze that's happening. So 2026, I'm calling like a mega IPO tsunami happening here. So of course we got SpaceX, which will be the largest ever by a multiple of 2 or 3, and so that's coming on June 12th. OpenAI is expected at some point later this year. I've heard some competition between OpenAI and Anthropic on which one will IPO first. OpenAI looking at around a $1 trillion valuation, Anthropic looking at a $500 billion to $1 trillion valuation. But you have other companies too. You have Databricks, which is another AI company that does data and such in the cloud, looking at for a $130 billion valuation. And then some non-AI companies. You got Stripe at $160 billion. That's still a massive fintech company. You also see Discord, which is the social gaming company with that helps with the messaging and such. We use it with our friend group, looking at a $15 billion valuation, which is still a massive company that's IPOing. It's just getting overshadowed by these truly behemoth companies. So when you combine the top 5 IPOs this year, that's $3.12 trillion, most of that being in AI. So, it brings up some questions about the actual demand for capital. So the stock market is capital being traded back and forth. And so originally the idea of an IPO is an initial public offering. You go and you try to sell portions of your company to get capital, raise that capital, use it to invest in and grow. And the market has a certain amount of capital that is available for these new IPOs each year. And this, like I said, just SpaceX is going to be larger than all the IPOs in 2025. All the IPOs combined for 2026 is going to be a multitude larger, like massive, with a $3 trillion. So seeing the market absorb all these new, what I'd call risk-on companies. So a lot of times when the markets fall, you hear risk off, you sell stocks, you buy some bonds. So even if everything is going up bull market, you have to trade some risk on assets, your stocks right now, for these new stocks to add to it. And we're going to get into a little bit about what that means for index funds and such. But we could see just oversaturation, oversupply of literal, just oversupply of stocks, oversupply of equity as in general. And that could hurt the markets.
Well, two things. One is that there's been a lot of cash hoarding from some of these tech companies. So some of that capital is going to come from other companies in the same industry. I mean, we've seen these circular deals, and we've talked about them before, of Oracle investing in the chip company, and then the chip company, agreeing, contracting to use their software and things like that. Apple, for example, huge cash hoard, Berkshire, Microsoft. Some of these earlier generation tech companies have enormous cash hoards. And so, some of that is in index funds. And so that's going to be a part of the source of this capital. But really, I agree. There's kind of an oversupply of money with some of these companies right now, between the massive tax cuts that we had and then the refunds of tariffs that are going to companies. Companies are able to add that onto their balance sheets right away when they collect these refunds. And so those are kind of temporary. And at some point, the tax cuts, they're ongoing every year, but the rate is probably going to stay the same for the rest of the Trump administration. His first term, he only got one major piece of legislation through. That was the 2017 tax cut. Now we're seeing real difficulty and just such a narrow margins in the Congress. It's hard to imagine any kind of major tax legislation coming out in the next 2 years. So that's going to probably be stable. So where does this additional liquidity come from? It does seem like there's going to be at some point a peak and then a fall off. I'm not, calling for any kind of correction immediately, but it's always around the corner at some point. The question is, how big is it going to be? And I feel like there's some pretty big forces gathering.
Also, it could be just a slow, tapering down of the euphoria. A lot of times we do see, a big pop and then a big crash, but we could see just a slow whimpering, we'll call it, where it slowly just cools down a little bit and it's flat for a long period of time. You make a good point on where the capital is coming from and some of the circularness of the AI economy, where NVIDIA sells the chips to Oracle, then Oracle sells the compute to OpenAI, and then OpenAI gets invested in by NVIDIA, and then everyone's just basically sending money back and forth. The trillions of dollars that I had mentioned with the valuation and such, that is, I would say, potentially overinflated, simply because when you think about it, like, I believe Anthropic has investments in it by NVIDIA and maybe by Google. I know that, I think, isn't it 49% or something of OpenAI is already owned by Microsoft. So a lot of these public companies already own these large chunks of the new IPOs. So it's still going to be asking for a lot of new capital, but over time, when they're fully absorbed by the markets, it might be a slightly smaller impact than I originally was saying. But it's still a fear of mine when you think about, so for all of you index fund holders, so you invest in, say, the S&P 500, whatever company you choose, and is holding the 500 largest U.S. Stocks mostly. And those companies, or those funds, are going to have to sell some of their 500 shares proportionally or whatever, and buy these new companies because SpaceX coming in as the 10th largest is definitely going to be in the S&P 500 at some point. It might not be day one, but it will be at some point. So doing some math, we look at just SpaceX. There are some difficult computations where there's float, which is the amount of shares that are available, and there's different like periods of times and like exchange rules for like the NASDAQ and the New York Stock Exchange. So it won't happen overnight, but SpaceX is going to be about 2.5% of the S&P 500. And it'll probably get absorbed over 2026, so the second half of the year. So I'm thinking there's going to be a 2.5% inherent lag in the S&P 500 just to absorb this IPO. Now, it isn't one-to-one like that, so it's probably going to be slightly less of an impact than 2.5%. But you also see all these other IPOs all hitting the same time. So I could see some actual disruption in these index funds that are market cap weighted. They have to buy the largest companies, and they're passive, so there's no thought behind the valuation or not of these companies. Is we have capital, we have rules-based capital. We're going to invest in this money, and to invest in this new IPO, we have to sell some of our holdings. So I think it'll be really interesting to see how this affects various index fund holders and the market as a whole. If any of you listeners are holding your S&P 500 and want to still have your diversification across the S&P 500, but don't want to hold SpaceX or Tesla or NVIDIA or whatever company. So there are various companies that let you do what's called direct indexing. So we do it at Silverstone for our clients, where instead of holding an index fund and holding everything, all 500 companies in that fund, we can directly buy the shares and hold fractional shares of them. So you don't need hundreds of thousands or millions of dollars to be able to proportionally buy the S&P 500. And by directly holding the 500 stocks in small quantities, we can exclude companies that for various reasons clients do or don't want, or sometimes they want to add, a 501st or 502nd company that is not included in the S&P 500. So I believe there are also companies online that you can do it without an advisor, do it self-service, but definitely something to look at if SpaceX or other companies that are IPOing you really don't want to hold. There might be solutions for it.
There's also equal weight funds where they will just rebalance once a year, and they put an equal amount in all 500 companies in the S&P. You lose some of the benefits of the market cap weighting, but you do gain that.
Historically, with equal cap weighted funds, there are a few drawbacks. One is you have more diversification. We'll say that. However, you sometimes have higher transaction costs. Some of them will rebalance a set period once a year. Some of them rebalance daily. So if you're rebalancing daily, you're having 500 trades at least every single day. It can add to costs there. Also, with the diversification side of it, you're essentially overweighting the small cap portion of these indexes. So the smallest companies, you have to buy more of them, and you're underweighting the largest companies, so you have to sell more of those. So it is an inherent choice that you're making that will affect your outcomes. Historically speaking, most years, I believe in the long term so far, equal weight funds have underperformed market cap weighted funds. However, that doesn't mean that every year or in the future that will be the case. It could be that some of these mega cap names, NVIDIA or Google, or some of the largest companies that have had these massive runs that are now, a huge portion of the S&P 500. I think it's like 40% of the S&P 500. If those start failing or doing badly, equal cap weighted will likely outperform, but it's hard to tell what the future holds.
If you don't want to own more than 4% of any one company, have more than 4% of your portfolio, and the biggest company is at 6%, well, then maybe you just put a third of your portfolio on the equal cap weighted or something. You can kind of come up with a balanced approach where you're just reducing that concentration to the amount where you're more comfortable.
Yeah, there are definitely some tricks you can do in portfolio management when you're doing these funds, or again, checking out the direct index. We have a whole page on our website under investment philosophy if you want to read more about direct indexing. We're big believers in it.
The last thing that I will say about all this, and SpaceX in particular, just the engineering challenges. Elon's fans will point out that, he takes on really big problems. And that's great. I also found it interesting that a couple of years ago, I was just digging up like some oddball things that Elon has said over the years. A couple of years ago in 2023, he said Tesla was basically worthless without self-driving because eventually the other electric car makers will catch up, and car companies that have more experience and more capital to invest in just in the factories of building cars, whether it's China or, Ford, General Motors, BMW. So when we think about SpaceX, they have done it. It's quite remarkable. These rockets that are reusable and they come back down and the claw grabs them and all that. But the challenge of really monetizing some of these other things with manufacturing in space, we have to realize that Elon's track record as far as a batting average is not that high. Neuralink claimed he was going to have these brain computer interface years ago. That's gone nowhere. The Boring Company that was going to make this high speed underground tunnel from LA to San Francisco, he admitted later that he just didn't want to see a rail company be built and he wanted to slow that down. The projects that they had for DC and other areas have been shelved. I hope that the technology pans out and it's beneficial, but his track record actually isn't that great.
There have been claims of having, full self-driving next year for, the past 11 years or whatever it is. So, there's definitely some worries about, this IPO is priced for perfection. Will it actually be able to achieve perfection? Maybe, maybe not. To be fair, Tesla has been priced for perfection for a long time, and the valuation doesn't follow our traditional finance metrics. So perhaps this will be similar, where it doesn't need to meet the various revenue targets that a normal company would, maybe because of Elon's vision or his personality or his fans. It might be able to still be a great investment regardless of the fundamentals behind it.
I think Starlink is the big opportunity here.
They can't buy just a portion of a company, unfortunately.
Yeah, unfortunately. I like their business potential the most out of all the components.
Well, thank you all for watching. See you all next time.